As Rajeev Malik puts it in his article today, we're in for a triple treat here in India. There's the budget to watch out for in a few days from now. We've got the MPC coming up in about a week, and then, of course, the big general election. Rajeev Malik, strategist at River Valley Asset Management, is joining us here on Bloomberg Quint. Rajeev, thanks so much for joining us. I'm borrowing words from your article this morning, but it sort of described it perfectly. I'm going to start, Rajeev, with a little, sort of start chronologically in some ways. We've got the budget coming up first, so I want to pick up that conversation. So I think there are two basic conversations, right? One is on the fiscal consolidation front, and the other is on this farm support scheme. On the first, Rajeev, would you expect the government this time to meet its target? I know people say that 10 basis points here or there won't matter, but they won't want to be seen as missing a target 2 years in a row.
Good morning, Ira. Thanks very much for having me here. I think they will meet the 3.3% of GDP target for FY19, only because I think they're going to slip a bit for next year. And also, as you rightly pointed out, they had slipped in the last fiscal year as well. So, overshooting a target in 2 years in a row doesn't look like a very promising picture. So my sense remains they will come through with 3.3, pretty much using all kinds of tricks available in cash accounting setting. And at the same time, for next year, probably stick to something like 3% to 3.3% of GDP.
Rajeev, behind that 3.3 number, if they do meet that this time, there will, as you said, be some cash accounting tricks, subsidies probably being rolled forward, plus a large component of an RBI dividend. Because if you look at the numbers available right now, clearly revenue is not matching up to expectations.
That is true. But, to be fair, and I fully well appreciate all the sound and fury about the quality of fiscal numbers and fiscal adjustment. But many of these issues are actually not new. I must confess my surprise as to all of a sudden why people are beginning to focus so much more on these. Do you recall at last year's budget anyone raising questions about how much of off-budget financing of some of the sectors was actually taking place? Not really. Have the rating agencies talked about this much? Not at all. So, this thing about trying to kick part of the subsidy bill into subsequent fiscal year is not being done for the first time. There will be other areas as well. But I think at one level, the positive is that no matter what they're doing, they are sticking to the headline number. Then we get into the second part, which is all about the quality, and there things look far less promising than the headline numbers would suggest.
How would you score them on their fiscal performance, Rajeev, over the last 5 years? Again, it comes down to the headline number where they've made some progress. But I think a lot of people pointing out that the continued de-emphasis on revenue deficit is the real problem. And they have stated that they don't even want to target revenue deficit from here on.
See, quite frankly, I'm less perturbed by them not necessarily targeting revenue deficit unless, one can have some really clear-cut good definitions in terms of how you're thinking about operating versus capital spending. In India's case, there's always a bit of a mishmash that sometimes comes into the picture. Overall, I think despite what on paper appears to be fiscal consolidation for central government finances, don't forget this government actually slipped on some years, pushed out achieving the 3% target by at least a couple of years. So all in all, one can take some solace that at least the underlying trend has improved. The deficit as a share of GDP has come down. But when you look into the details, it is not all that comforting. One of the issues that I've been talking about for years, and nobody seems to care, actually not very many people seem to care, certainly not the government, is this constant bit about using divestment proceeds as part of the budget revenues, as opposed to thinking of it as a financing item, which is what IMF's best practice is. That'll tell you that India is actually running its fiscal deficits size-wise much larger than what the official numbers tend to to state.
Oh, absolutely, and you point that out in your article this morning as well. Rajeev, undoubtedly the conversation though is not going to be about the fiscal deficit number. It looks like this whole farm support story is going to take over. I have a couple of questions on that. I know hypothetical, but still. Firstly, from the stated numbers on the economy that you have available, are you convinced that there needs to be a significant farm support program?
Well, I think to answer that question, it's not really so much the budget one needs to think about. The budget question comes in whether or not it can be, can the government afford it? But does something need to be done for the acute distress as far as the agriculture sector is concerned? Without a doubt. But again, there's nothing new. I mean, to be fair, this government has ignored the sector for most of its tenure. And now you're getting into election, and there's obviously a fair amount of angst. So you want to seem to be addressing it, and perhaps even want to genuinely address it. But it is not something that can be done in one go. My own sense remains, even if there is a cash transfer scheme that's announced, I think the concept and the idea will be played up quite substantially, and perhaps even a small step is taken in terms of subsuming some of the existing subsidies into that. The biggest risk, and this is just behavior of how Indian politicians and financial fiscal management has worked in the past. What you don't want to happen is a brand new liability being created, a recurring liability being created as a result of this program without addressing any of the existing expenditures, for example, on subsidies, etc. And in India, politicians find it very, very difficult to take back what they've once given. So how that granularity comes about is going to be extremely important. But bear in mind, a lot of these details are really going to come up in the full budget after the general election. I don't think anybody should be waiting for all the nitty-gritty details to be announced in the budget speech or even in the budget document.
Sure, Rajeev, but there would have to be a distinction made between a cash transfer scheme, which, as you said, could subsume existing subsidies, at least fertilizer and, say, crop insurance, and something in the nature of a basic income or a minimum income guarantee, which the Congress talked about yesterday. Those are two separate things. The cash transfer is simply taking the same amount and giving it by cash rather than in kind. Less damaging, perhaps, than an income transfer scheme from a fiscal perspective?
Well, ultimately, first of all, bear in mind, I mean, Congress is not the ruling government, so they can float any kind of trial balloon idea. All I want to say is, show me the money. And much as a former finance minister has come out and said that they will be fiscally responsible, I'm like, yes, exactly. What else is he going to say, right? I mean, so bear in mind, Congress can try and float any number of ideas, but unless they have some really structured arguments, including how it's going to be financed, it's really anybody's guess, right? I mean, you can ask for the moon for all I care. The issue, you are right, that the cash transfer scheme should not be necessarily point for point in terms of some kind of a minimum income support scheme. But bear in mind, I mean, first of all, the UBC, universal income support, is not something that I think should play out necessarily for India, because the super rich or the upper middle class don't necessarily need that kind of support. Secondly, all these things can't be announced just in one way, at one time. So you start off with what is the most essential, and that is really addressing the farm sector, and then you move in a step-by-step manner forward. You really can't have both of them full-fledged operating at the same time and still wish to land up meeting all your fiscal targets. As I often say, if wishes were horses, Indian finance ministers would ride them.
For sure. Rajeev, just that last point on this, sort of a bit of amusing than a question. When the government started and they kept minimum support price hikes contained, I think all of us sort of celebrated it. We said, great for inflation management, and certainly, perhaps that is one reason why inflation has been under control. It's come back and hit them in a different way. Certainly, the minimum support prices and the pace at which they were increased would be a reason why we are talking about the farm sector distress this time around, you think?
I think there's more than that as a main reason. Don't forget, farm sector has been ignored for the longest time, right? And each election cycle, we come in, we try and do a band-aid fix. MSPs are not really necessarily the way to fix the problem in the farm sector. One of the most important which is that it is not really profitable or worthwhile many of the farmers to necessarily spend all that time and effort, right? So you have to make sure that commercially it becomes more of a viable operation. You cannot manage inflation for all of India by making sure that the farm sector actually remains uneconomical in that sense. So I think one of the biggest misses has just really been thinking on that front. So yes, restraint in MSP hikes in the beginning of their term, the government gets good credit, full credit for that. But while they were doing that, what happened to all the other steps that had to be taken? So once again, these things get ignored till the problem becomes a mountain, and then you want a quick fix, and then you would justify slipping on the fiscal simply because it becomes very essential. So it becomes a whole Pandora's box that you'll end up opening by not having addressed some of the things at the very beginning in a systematic manner.
Absolutely. Rajeev, that allows me to sort of segue into the other big event that will come up next week, which is monetary policy. Again, it'll be an interesting meeting. You're predicting a rate cut already, even though they haven't actually moved on stance. So you think they'll move on stance? There's enough reason to do that together with a rate cut?
Well, my sense is I think the MPC is late both in shifting its stance to neutral and in cutting rates. To be fair, don't forget the MPC had actually raised rates twice before changing its stance, right? And that is simply because some of these things are evolutionary, the way some of the risks were presenting at that time. I don't think they could really look far ahead and signal a change in stance and also raise rates at the time. So they did it incrementally. It just so happens it landed up being twice, and then they shifted their stance. There's no reason why the stance can't be changed and a rate cut be announced at the same time. I mean, there's no rule book that says that that can't be done. In fact, I would have argued that they should have shifted stance at the last meeting. But then you get into all these things at MPC. There are a lot of question marks. You want to see how oil prices are going to behave, how inflation will going to play out, etc. Many of these are understandable, but perhaps used more as an excuse, simply because the magnitude of shift we saw in oil since October was actually pretty pronounced, and there is no reason why the MPC should not have moved a bit faster than it typically would, right? So this is a natural inertia cycle in a way that will take time and look at more information before deciding. There was a reason to shift stance, and there's a reason to cut rates. Now, it is important to emphasize, I don't think there's any strong case, or actually even a weak case, for an aggressive easing. My sense still remains, and it's a non-consensus view I've had for some time, that there will be 2 rate cuts. And that pretty much justifies they can be on a neutral setting and still be able to come through with those. That is not the end of the world at all.
So these are sort of mini cycles then, Rajeev, in the sense that, we saw 2 rate hikes, now we see perhaps, 1 or 2 cut. Then nobody is convinced that food inflation will stay low. If, on top of core food starts to rise, we may again come back into sort of a potentially rate hiking or tightening scenario?
Well, I mean, the very fact that they moved to a neutral just tells them that they're ready to go either way, right? So let's not prejudge that which way they're going to go. And it's interesting, a lot of the discussions regarding the food inflation, which I think is unsustainable at the current levels, especially if you think something needs to be done for the farm sector and to make it commercially more viable over the medium term. But equally, core inflation is interesting. I mean, one needs to look into a lot of the details. The typical accepted, arguments that, look, core inflation is high, so therefore demand pressures are the one that's driving it. partly because the output gap is closed, etc. Now, output gap is a theoretical concept. But there's a lot of other stuff that's also happening in core that will tell you either there are some of these one-off adjustments that are coming through. Certainly there are questions that need to be answered for all the distress in the farm side. On the farm side, is it a reason why rural core inflation should have spiked as much as it has? Is it going to be sustainable? The services side pretty much concentrated as far as food and education and health are concerned. Is that something monetary policy can really address? So there's a lot of stuff that needs to be addressed, but the bottom line the MPC needs to understand is that its legally mandated indicator is the headline number, headline CPI. Obviously, everyone has to look through the underlying drivers and gauge how sustainable the underlying trend is before deciding on policy response. But is there some room that's opened up in the near term for slight easing? I think so. That in no way means that, look, over the medium term, the risks could still persist. But there's no reason why it can't move now, even if it's concerned about what's going to happen down the line. And its own inflation forecasts would actually give us a clear indication of how its thinking is evolving.
Rajeev, I'm glad you bring up this, sort of core inflation versus headline inflation issue, because in the last few weeks, every time someone has told me, mostly from the economist fraternity, that, we can't cut rates right now because core is high, my argument has been, then we should have targeted core. Why did we pick headline as the target? Incidentally, Dr. Rajan was in Davos, and he said we picked headline because we thought that was the tougher target.
Well, I mean, don't forget, I think he's probably right at one level, because targeting food inflation tends to be a lot more volatile than core inflation, right? And even now, given where core is, if for all of a sudden over the next 6 months food suddenly goes the other way, we would be all in a pickle. But what is the probability of that necessarily playing out, right? So the MPC or a central bank has to think of itself as a risk manager. Not necessarily a hedge fund manager, but they have to manage risks for a variety of different reasons. And the reason for targeting headline number was also simply because it is much easier to communicate, right? So the MPC can't be behaving that it is actually targeting core, even though its legal mandate is for headline number. And I fully well understand that one has to look at the constituents to decide what the headline is going to do. But really, there is some scope that's opened up for easing, not to mention real interest rates are actually still high. A lot of people tend to forget about that when they focus on core inflation alone. So there's a strong case for them to shift. That doesn't mean that it's going to be, a very aggressive easing as the political masters might necessarily want.
Sure. Rajeev, I have a couple of last questions. One still pertaining to the RBI and the quantum of open market operations that they've done. I know they're targeted at liquidity, and liquidity conditions have been tight, so they have been pumping in money. But the quantum is very large this year. In many ways, they've sucked up most of the amount that came in via fresh government supply, which is probably why we haven't seen government bond yields go up very much.
That is true. It's a fair point, but don't forget, RBI had also clearly stated that they will provide liquidity as is needed, and any central bank can really only have a good handle on its monetary mechanisms as long as the system remains in a slight deficit. It doesn't need to go into surplus mode as such. The question is really going to be over the next 12 months, how are they going to play, especially in terms of the scope of OMOs, and I think part of the decision is going to be impacted by what happens with overseas flows. But clearly the stopgap, RBI has been clear in which way it wants to go. I do hope that they don't necessarily mess around with the cash reserve ratio. There's really no need for them to do that, at least at this point. Also, don't forget, under Rajan and under Patel, one of the disciplines that RBI managed to achieve was to get away from this typical thinking that bureaucrats and a lot of market analysts had, that every time there is a bit of a liquidity tightness, etc., that everyone comes screaming for a cash reserve ratio cut. So that really isn't needed, certainly at this point, and in fact should be put on hold. There are many other instruments still very much available.
All right, Rajeev, last word from your perch in Singapore as a strategist. How does India look to you as an investment destination? I mean, you know, we're quibbling about growth slowing down, but it is still likely to be 7-odd%. I don't know if corporate earnings have kept pace or not, but as an investment destination?
Well, it's interesting, right? So everyone plays up India's story, and we always try and get rid of the hype around it. I still can't explain how the country that has among the highest real interest rates manages to have the highest GDP growth rate. So obviously somebody needs to look into more details on that front. But it's expensive. And you know, you have a major political event with uncertainty around it. Don't forget, Indian markets premium relative to rest of EM is still pretty substantial. And while earnings growth will turn around finally this year, one has just been hoping for that for several years now. So it's very much wait and watch into run-up to the election, which is, again, a big event.
All right, Rajeev, we'll leave it at that. Thanks so much. Always a pleasure speaking to you. Hope to have you back post all these major events as well. Thanks so much.
Thanks very much, Ira. Cheers.